The key to success in cryptocurrency is having a robust trading strategy. This is something that the average crypto holder doesn't have, hence why many of them end up in the red. At one extreme, you have day traders who think that a bull flag on the 15-minute chart means we're headed to the moon. At the other extreme, you have hardcore hodlers who have no idea what a bull flag even is. As a result, most traders end up getting wrecked because they're trading too much, and most hodlers end up getting wrecked because they have no idea when to sell. Now, I've spent a lot of time at both ends of this spectrum, and after years of learning from my mistakes, I've managed to put together a crypto trading strategy that works well for me. So today I'm going to tell you all about my personal crypto trading strategy, including when I buy, when I sell, and how I choose the cryptocurrencies I trade. Before we open TradingView, there's a disclaimer I need to give to you. Financial advice is not my field of expertise, so contact a financial advisor if you need help getting cheese. There is only education and entertainment in this flick, and I hope that what you see today will stick. If this is your first time in my presence, my name is Guy, and some would say I'm a crypto legend. That's because I make some of the highest quality crypto content on the planet. Coins, tokens, exchanges, news, reviews. If it's crypto related, this channel has it. If this sounds like music to your ears, subscribe to the channel and ping that notification bell so you get a ding when the next video is here. I know you've got things to do, which is why I've left timestamps in the video timeline, just for you. You can use them to skip around, but remember that watching the whole way through will help this video get found. So that's all you need to know about me. Let's unpack my personal crypto trading strategy. The backbone of my personal crypto trading strategy is Bitcoin. This is simply because BTC's price has a huge influence over the price of other cryptocurrencies. At any given point in time, BTC's price is doing one of three things: going up, going down, or staying relatively stable, or at least as stable as a cryptocurrency can be. When BTC's price is increasing gradually, it typically carries altcoins along with it, especially larger altcoins like Ethereum and Cardano. However, if BTC's price is pumping hard, it tends to leave altcoins in the dust. This is primarily because BTC is seen as a safe investment. If BTC is pumping, people tend to take altcoin profits and move them into BTC for a safer trip to the moon. When BTC's price is going down gradually, it tends to pull down the larger altcoins with it, though some smaller ones can continue to perform well. If BTC's price is crashing hard, then obviously everything else goes down with it. This is for the same reason as before. If the crypto market is crashing, BTC is a good place to be, and this leads to lots of aggressive altcoin sell-offs as thousands of traders cling to the Bitcoin life raft. Naturally, this movement of money between altcoins and Bitcoin is somewhat cyclical, and one of the indicators I use to figure out where we are in this cycle is Bitcoin dominance. Bitcoin dominance is a measure of how much of the total crypto market cap is just BTC. If Bitcoin dominance is going up, this means money is moving from altcoins into BTC. If Bitcoin dominance is going down, this means money is moving from BTC into altcoins. So once I've assessed Bitcoin dominance, I need to confirm that the market is headed in the direction that I think it is, and I use the total cryptocurrency market cap for that confirmation. If, for example, Bitcoin dominance is going down, but the total market cap is also going down, I typically stay away from trading altogether, since it suggests we're on the brink of a dip. Alternatively, if Bitcoin dominance is going down, but the total market cap is going up, then this means altcoin season has begun. As you can see here, Bitcoin dominance is pretty damn low, yet the total crypto market cap keeps going up. When we get to these kinds of levels, it suggests that we're entering the peak of a bull market cycle. Now, I actually think that we might see the top in mid to late September, and I have a whole video dedicated as to why that is, which you can find up there in the top right. Once I've established where we are in terms of the altcoin-Bitcoin cycle, the next thing I do is estimate how long this stage of the cycle could last. This is where the technical analysis starts to come in. As I mentioned in the third installment of my technical analysis tutorials, analyzing timeframes shorter than a day can create a lot of noise in the price charts, and you often lose some much-needed context. This is why I always stick to longer timeframes, and if I'm looking to buy or sell BTC, I start with the monthly and the weekly. What I'm looking for here is a price pattern that could forecast future price action, and I reckon I see one on BTC's monthly chart. Recently, I've gotten into the habit of spotting what I like to call the topless letter P. This is when prices pump, pull back, and then pump again to the price of the initial pump. This pattern is similar to a bull flag in that the price gain between the top and the bottom of the initial pump is roughly how high prices will go if the pattern plays out. In this case, it's looking like a 90 to 95k for BTC in the coming months, assuming that what we're seeing is in fact a topless P. If it is, then I would allocate around the zone of resistance in the topless P, which is at roughly 58k. I'm seeing the same story for BTC on the weekly, which is starting to paint a bull flag that's similar to the one we saw earlier this year, albeit a lot limper. This just leaves the daily time frame, and this is where I start to slap on some indicators. Now, I usually just stick to moving averages, specifically the 200-day MA, the 50-day MA, and the 128-day MA. The 50 and 200-day MAs are the bread and butter of many traders. This is primarily because the 200-day MA is seen as a strong sign of support. Above is bull, below is bear. Given that we're comfortably above the 200-day MA, I take this as a sign that it's safe to swing trade whatever part of the altcoin Bitcoin cycle we're currently in. Though the 50-day MA is another significant level of support, its significance comes from its relationship with the 200-day MA. Now, as some of you know, when the 50-day MA crosses the 200-day MA from above, that's called a death cross, and it means we're headed for some hurt. If the 50-day MA crosses the 200-day MA from below, that's called a gold cross, and that means we're about to see some serious gains. BTC is slowly forming a golden cross on the daily, and as Benjamin Cowan recently pointed out, we'll probably see it in mid-September. Total coincidence, I'm sure. Anyhow, the 128-day MA is a more recent addition to my trading strategy. I only really pay attention to it when the price of BTC is collapsing. This is because the 128-day MA has historically been a super solid zone of support, and if you were using it back in May, you probably saved yourself a lot of pain. I'll be keeping a close eye on the 128-day MA in the weeks ahead, and this time I'll be sure to use it to cut my losses if we happen to break down below it again. Now that I've established what BTC is doing, I can finally turn to my altcoin holdings and see if there are any buying or selling opportunities there. If you're subscribed to my weekly newsletter, you'll know that I adjust my portfolio once every week or so. Even though that's the case, more than half of my holdings at any given time are in BTC and ETH, and the way I trade these cryptos is very different to how I handle the others. In my eyes, BTC and ETH are the most mature assets in the crypto market, hence why I apply the longer-term trading approach I mentioned a few moments ago. Once I've spotted a bullish pattern on the monthly, daily, or weekly, I set what I believe to be a realistic price target and take profits along the way as prices rise towards that target. Using the topless P on the BTC monthly as my template, 90 to 95k would be my realistic price target, and any visible zones of price resistance on the weekly and/or daily would be my take profit points along the way. In this case, that's around 50k, 53k, 56k, 59k, and 63k. That said, how much I sell really depends on what the market is looking like when those targets are hit. If some insanely bullish news about BTC just came out and it's blasting through every single one of those price zones, then I'll sell less than I otherwise would have and keep an eye out for a blow-off top. Once I've taken some profits, I usually park them in USDC, though recently I've got into the habit of putting some of these profits into PAXG, which is a gold-backed token issued by Paxos. Now, if you're wondering why I hold my profits in PAXG, it's partially because I see gold as a safe haven asset, but partially because PAXG tends to pump way off its gold peg when the crypto market is crashing. This makes PAXG an even better hedge against crypto market volatility, and gives me the chance to make a few extra bucks if I manage to sell the top of that off-peg pump. Now, I'll leave my video about gold-backed crypto tokens in the video description if you're interested. If you're wondering why I take profits at all, it's because I'm a believer in buying the dip. I detailed my buy the dip strategy in another video, so I'll just give you the short version here. If I can see that prices have fallen beneath the Bollinger Band range and the RSI is insanely low on the daily, this to me is the perfect buy the dip opportunity for BTC, ETH, and other large altcoins. This brings me to how I trade the other 10 cryptocurrencies that are currently part of my portfolio. But I'll start by briefly answering a frequently asked question, and that's why I don't hold all the cryptocurrencies I say I'm bullish on. Well, this is basically because there are other cryptocurrencies which I think have more potential in the near term. These are the ones I hold in my portfolio. You can learn more about why I structure my portfolio the way I do by using that link up there in the top right. Anyways, when I take profits on altcoins depends on a few factors, namely whether we're in an altcoin season or not. If we're not in an altcoin season, I apply the same sell the top strategy I detailed in another video, which I'll leave in the description. However, if we are deep in an altcoin season and everything is pumping like mad, then the standard method of when I take profits can quickly become irrelevant. A great example here is Arweave's AR coin, which kept pumping and pumping and pumping against all odds. Now, when an altcoin is doing this, I pay more attention to my percentage gains rather than the price or any indicators and patterns. If one of the altcoins in my portfolio has doubled in price within a few days, I will typically take some gains off the table, and that dry powder will go into either BTC and ETH or USDC and PAXG, depending on market conditions. If an altcoin I'm holding has been gradually growing over a longer time frame, I will actually add to that position every so often, which is what I've been doing with Solana. If and when that blow-off top phase comes, I will again take profits based on the percentage gains I've made since I bought the coin or token. The higher the percentage gains, the more profits I'll take, always keeping in mind all the other stuff about that crypto that's going on at the time. Now, although I do my best to hold on to my underperforming altcoin bags, if they're looking extremely bearish compared to the others I have or am considering holding, I usually bite the bullet and bail out. The way I assess whether I need to do this is by looking at the weekly and monthly price charts for the classic market cycle depicted in the Wall Street cheat sheet. If I can see that the tail end of this cycle is being printed on the price charts, it means it's time to move on to greener pastures, assuming there are still greener pastures around, of course. Whenever I happen to come across a new altcoin that seems to have some serious potential, I do as much research about the project as I can before I put down a dime. This is because any new crypto investments I make are based primarily on the fundamentals of the project and not so much on the technicals of that coin or token. Arweave is again a great example here. I added AR to my portfolio after realizing that all of Solana's blockchain data is stored on Arweave. AR has some rock-solid tokenomics as well. Because I'm bullish on Solana, it's only logical that I hold AR, because it's used to pay for storage fees, and as Solana's use increases, so too will the demand for AR to store all that data. Demand drivers are one of the primary fundamentals I look for in a cryptocurrency. Even if a coin or token has piss-poor tokenomics, with sufficient demand, it can still find its way to new all-time highs. Now, demand drivers are definitely not the only thing I look for during my research, however, and you can learn about the other factors I look at by clicking that link up there in the top right. Though not necessarily fundamental, another factor I look at before copying a new crypto to trade is its market cap. As I've mentioned many times before, the market cap of a cryptocurrency is ultimately what determines how high it could go, and not its sticker price, which can sometimes be deceptively low. Market cap is an extremely important metric for my crypto trading strategy because it helps me estimate the percentage gains it's likely to see if it goes crazy. I'll use Arweave again as an example because, well, just because. AR's market cap is currently around $2 billion, and assuming BTC continues to hold or grow and Solana continues to rally, I think AR could still 3x from here. With that in mind, I can set price targets to sell. Because I bought around the $40 mark, I could sell a bit at my 2x mark, which is $80, and a bit more at my 3x mark, which is $120. Depending on how things are looking at that time, I could let the rest ride up to a point where I'm happy with the percentage gains I've made. Obviously, if I was doing this with a brand new cryptocurrency, I would do my best to get in at a point where prices aren't going through the roof. The perfect entry would be the other side of the topless P, which is roughly where I got in with Arweave. If I hadn't seen any sort of pattern, I would have gotten into AR a few days earlier. And in case you're wondering, yes, I do have a video about Arweave, and you can find it up there in the top right. And there you have it, folks, my personal cryptocurrency trading strategy. I know it sounds simple, but I'm no more a professional trader than I am a financial advisor. I learned the hard way when I tried my hand at trading timeframes shorter than a day. Though I'm still tempted to fall into that trap from time to time, my profits have been much more consistent with longer timeframes, and I reckon that's because it's easier to keep your cool from a bird's eye view. On that note, it boggles my mind that so many crypto holders don't factor in BTC when analysing their favourite altcoins. This is nothing short of a fatal error, because BTC is what makes or breaks the crypto market at the end of the day, and BTC's market moves are ultimately dependent on institutional moods. Altcoins, on the other hand, are a whole different ballgame because most of their holders are highly emotional retail investors looking to get rich quick. This can and often does lead to price action that's nothing short of irrational, and in cases like these, your own, hopefully realistic expectations become the best indicator of what comes next and how you should react. Selling the news is definitely a good rule of thumb to follow, but it's the fundamentals that ultimately carry a crypto to the highs that every trader dreams of. In my opinion, we're at a point in the bull market where most of the best cryptocurrency projects have already made it into the top 200 by market cap. Though there are certainly a few outliers, investing in low-cap altcoins is not something I'm generally comfortable doing. The same goes for these videos. I know you will want me to talk about those next low-cap gems, but we both know that, well, if I talk about them, people will blindly ape in without doing their research and get wrecked. And besides, if I covered these low-cap gems, they might not be low-cap gems anymore, right? If you follow the fundamentals, you will find them. When you do, remember to come up with a trading strategy that works for you. And if you stick to it, you will make it to the moon. That's all I've got to say for today. If you liked what you heard, be sure to leave me a like before you go on your way. If you plan on staying, subscribe to the channel and ping that notification bell to become a part of my crypto domain. I've loads of other content for you to consume on Twitter, TikTok, Instagram, and even elsewhere here on YouTube. I also give detailed updates about the crypto markets on Telegram every day and send out a weekly newsletter that contains all the info you need to help maximize your gains. If you want to steal my look, the Coin Bureau merch store is where you'll find hoodies and tees like these. You can find your way to all these resources using the link down below. And if you come across anyone who claims to be me and is offering to help with your crypto, just say no. If you made it this far, I appreciate your dedication. It was my pleasure to provide this entertainment and education. So thank you so much for your view. Don't forget to share this video with your crypto crew and keep an eye out for my next video, whatever you do.